Hi everyone, good afternoon. Welcome to our webinar on VAT in the digital age. We're glad you could join us today. Let's wait 1 or 2 minutes until everybody has joined and then we will start the webinar. So I think most people have joined us now. So welcome everybody to our webinar on VAT in the digital age. Over the next hour, we will be walking you through the key changes coming under the EU's VAT in the digital age package, also referred to as ViDA. ViDA is a major reform that aims to modernize the VAT system across the EU. This is often in light of today's digital economy. We will cover what is changing, when these changes are expected and what they could mean for your business. And we hope you find this session useful and informative. If you have any questions during the webinar, then please send them in the text, in the chat, and hopefully we will answer your questions during the webinar or at the end of the webinar when there's still time. Okay, so let's start. Let us start by giving you a quick overview of what we're going to discuss today. First, we will begin with a short introduction of us as speakers, so that you know who's talking to you. And then we will dive into the background of ViDA, why it was proposed, what problems it's trying to solve, and how it has moved through the legislative process from proposal to adoption. And then we will go into the heart of ViDA, and there are 3 pillars involving ViDA. And each is discussing a separate part. So pillar 1 will be about e-invoicing and digital reporting requirements, which aims to harmonize the reporting across the EU. The second pillar is about the platform economy, which is trying to make fairer competition between platforms and traditional businesses. And we have the third pillar, which is about the single VAT registration, which is designed to simplify compliance for businesses operating in multiple EU countries. And lastly, we will discuss what to do now. So in this part, we will discuss how you can prepare for ViDA, although the change will be coming in the next couple of years. You can still prepare with your business for ViDA, even though the changes have not been implemented yet. So with that roadmap in mind, let's get started with some quick introductions. So, my name is Michel Ruitenberg and I'm an indirect tax partner working at Crowe Foederer in Amsterdam. I've been working in the field of indirect taxes for several years already, not only in the Netherlands but also in other countries, and since recently I joined Crowe Foederer, but I've been part of the Crowe network for more than 8 years. And I'm giving this presentation together with my colleague Bart Matthijssen. He's a senior manager indirect tax in our team. Bart also has a wealth of experience in advising on indirect tax compliance and advisory matters. Together we have a combined experience of more than 23 years in indirect tax, so I think that's a nice gimmick. So we are excited to guide you through the ViDA changes and share some practical insights along the way. So let's get started with the background. So in short, the goal of ViDA is to modernize the EU VAT system. The current system has been showing its age, especially when it comes to keeping up with modern business models, like those in the digital and platform economy. There are 3 reasons behind the push for these reforms, which we'll explore in more detail later, but just to summarize them here. The first of all is to reduce the VAT gap. Now, what is the VAT gap? VAT gap is the difference between the expected revenues by the governments and the actually collected revenues. Second one is to create a level playing field between platforms and traditional businesses, because there is sort of an unfair competition between the two. And third of all is to reduce the number of EU VAT registrations that businesses need across the EU countries, which is something that is currently a major compliance burden. So let's have a closer look at these 3 drivers, starting with the VAT gap. So as I said already, the VAT gap is the difference between the expected VAT revenues and the actually collected VAT revenues. And the difference between the two is the amount that the governments are missing out on. So there could be different reasons for this VAT gap. Things like bankruptcies, administrative errors, unclear VAT rules, aggressive tax planning, and of course fraud and tax evasion. Among these drivers, fraud and evasion are by far the biggest ones, which is one of the reasons why ViDA was proposed, especially Pillar 1 about the e-invoicing and digital reporting requirements. This is designed to make a big impact and reduce the VAT impact. So with Pillar 1, the authorities have the tools to better monitor transactions in real time, and that makes it easier to detect and prevent fraud before it happens. By increasing transparency and improving data, the digital shift should help close the VAT gap significantly. Now, to give you a concrete example, here you can see a visual showing the VAT gap in the Netherlands from 2018 until 2022. 2022 is the last year that it was measured. But in 2022, the VAT gap was approximately 6 billion euros, and the total VAT collected was approximately 70 billion euros annually. And this VAT gap represented approximately 7.9, almost 8% of the VAT gap, of the VAT total tax liability. And the Netherlands is the 16th amongst EU member states when it comes to the VAT gap. So you see here that the Netherlands, even though we have a strong compliance in this country, the VAT gap remains a serious issue. This just highlights how real and relevant the problem is, and why tax authorities are so focused on finding ways to reduce the VAT gap through measures like the ViDA package. Another reason of the ViDA package is to reduce the number of EU VAT registrations. So I've given you a simplified example here. So in the current situation, if we have a Dutch company, for example, and this Dutch company is operating through trading goods in several EU countries, it may need a local VAT registration in those countries. So for example, it may need a local VAT registration in the Netherlands, but also in France, Germany and Belgium. And after the ViDA package is implemented through one of these changes, for example, by the expansion of the one-stop shop scheme, the Dutch company does not need any more VAT registration in all the EU member states, but also only in the Netherlands, and through the Netherlands it can remit the VAT that it needs to pay in the other member states through the local tax authorities in the Netherlands. So third of all, also one of the reasons of the ViDA package is to create a level playing field between platforms and traditional businesses. Now, what is the issue here? We see a huge number of platforms acting as intermediary between platforms and suppliers with underlying goods and services that are being supplied. Now, the issue here is who should charge the VAT on the underlying good or service that is being provided. In many cases in the past, platforms did not account for the VAT on the underlying good or service where they actually should have. For example, you can see here a news article about Uber. Uber, of course, provides transportation services, and in the past it did not collect the VAT on the transportation services it provided. In this case it was the UK, and it was facing a huge VAT bill that it had to pay in the UK because it did not account and remit the VAT that it had to on the transportation services to the tax authorities. Now, after ViDA, these platforms will become liable to charge VAT on the underlying good or service, which means that they have to collect the VAT and remit this to the tax authorities. Next, let's have a look at the legislative process of the ViDA package from proposal until adoption. It started back in 2022. In December 22, the ViDA package was originally presented by the EU Commission. And then after that, all EU member states had to agree on this ViDA package. So it took a couple of years until 5 November 2024, until eventually a political consensus was reached between all EU member states. And after that, the EU Parliament and EU Council have to give their approval. So the approval was given by the EU Parliament on the 12th of February 2025. And after that, the EU Council gave their approval in March 2025. And shortly after that, in 25 March 2025, the amendments were officially published to the EU VAT directive, representing the ViDA package. Now, of course, after these changes are published, this legislation needs to be implemented in the local tax legislation of all the EU member states. And we have 3 pillars that will be implemented in different phases. So that means that the countries have from 2025 until 2035 to actually implement all the changes under the ViDA package. So in this slide, I'm giving you a list of bills that has been recently published by the Dutch government, and this represents the tax bills that will be initiated in the next couple of years. And in this list, you already see the changes of the ViDA package represented here. So, for example, the single VAT registration is already mentioned. That will be implemented in January 2027, July 2028, or July 2029. You see here that the changes for the platform businesses that will be implemented in July 28, and the e-invoicing and digital reporting requirements will be implemented by the Netherlands in 2030. So that gives you a sort of background about why the ViDA package was proposed, what are the main drivers or contributors for this ViDA package, and the legislative process. Now let's have a deeper look at the different pillars of the ViDA package. So the first pillar is about e-invoicing and digital reporting requirements. One back. E-invoicing is not exactly new. It's already part of the EU VAT law at the moment. However, what is changing is that now e-invoicing will be mandatory for certain types of transactions. Plus there will be harmonization of how the e-invoicing format is structured across the EU, ensuring a consistent approach for all member states. On the other hand, there is also the digital reporting requirement. That is a completely new concept under the ViDA package. This will also be mandatory for certain types of transactions and will give tax authorities the ability to track transactions in real time. So what types of transactions are covered under this pillar? That are the intra-community supplies and acquisitions, so basically cross-border supplies of goods and services. The transfer of own goods and supplies that are subject to the reverse charge VAT. And as I said already, this is mandatory for the B2B intra-EU transactions. However, it is not mandatory for other types of transactions, but optional. So that for the other types of transactions, the member states have the option to implement that in their national legislation. And if they do so, then of course they have to comply with the requirements under the ViDA package. So now let's have a closer look at how the e-invoice after ViDA will look like. Here I will discuss the format of the e-invoice, when it needs to be issued, what are the requirements and what are the conditions to accept this e-invoice, and how can it be sent from the supplier to the buyer. First, let's have a look at the format. One of the key changes is that the e-invoice will be harmonized across the EU. That means that all e-invoices will need to meet specific technical requirements based on the standards set by the EU law, and most importantly the EN 16931 format. Now, of course, that doesn't ring a bell for most people, I think. What does this format mean? It defines what information must be included on the invoice, such as the invoice number, the date, the amounts, the VAT amount, and the total amount due. It also defines how that format is structured using a specific technical format. Typically, this is done by XML. And also it defines how systems should interpret that data so that it can be automatically read and processed by both businesses and tax authorities. Then let's talk about the timing. The e-invoice must be issued 10 days after the taxable event, so when the service is provided or the good is supplied. And in case there is an advance payment, then the e-invoice must be issued 10 days after the advance payment. Currently, there is a requirement for the buyer to accept the e-invoice if there is an e-invoice that is issued. However, after ViDA, the approval of the buyer is not anymore required. So that means that in case the e-invoice is issued after 2030, then the buyer's approval is not anymore required. It will be automatically seen that a correct e-invoice is issued. Now, how can this e-invoice be sent from the buyer to the seller, from the seller to the buyer? This can be done by any means. So basically, the seller can send it directly. He can use a third party, or he can use a public platform. What you see in other e-invoicing methods or countries which have already implemented an e-invoicing system is that the e-invoice is sent directly to the tax authorities, or there is a third-party platform involved. However, in the case of the EU, that is not the case. So let's have a deeper look at the technical requirements of the e-invoice and what will be different between how the invoice looks like now and how the invoice looks like after 2030 for B2B intra-EU transactions. So currently, you have a lot of flexibility. You can use paper invoices, PDFs, or a variety of electronic formats. But with ViDA, only structured e-invoices following the EN 16931 format will be accepted. So that means invoices will need to follow a standardized XML format. Second, the meaning and structure of the invoice data, that is what we call semantics, can vary quite a bit. It depends on layout and labels used by the business or the country. After ViDA, these semantics become explicit and standardized. All invoices must follow the same data model, so the way information is structured and understood will be consistent across the board. Third, invoice processing today is often manual or semi-automatic. But after ViDA, things will be fully automatic. That's because the e-invoices will be structured in the same way across all EU member states. So the processing will be smoothly and no human intervention will be required, as expected at least. And then we have the interoperability, so how it can be used in different EU member states, and the adaptability to automation. So yeah, like I said, the e-invoice will be structured in the same format. It will be used in the same way in all EU member states, which means that they're highly likely to be standardized, that they will have standardized semantics, and that they are designed for full integration into digital systems. Now let's move on. Some countries, they have already implemented an e-invoicing system. Or they will plan to roll out an e-invoicing system in the next couple of years. And these countries, they will not be required to implement e-invoicing in 2030, but they have the time until 2035 to comply with the changes under the ViDA package for e-invoicing. So for example, Romania and Italy, they have already implemented e-invoicing for certain types of transactions in 2019 and 2024-25. And then you have Belgium, France, Poland, and Germany, which will roll out e-invoicing in 2026 and 2027. So if you're already doing business with these countries, it's good to follow the invoicing rules that are already in place or will be in place in the next couple of years. Next to e-invoicing under Pillar 1, we also have the digital reporting requirement, or DRR. This is introduced for near real-time reporting of intra-EU B2B transactions. And I think it's important to mention that this will replace the current EC sales list. Now the EC sales list is already filed at the moment, monthly or quarterly. But in this case, the digital reporting requirement is a bit different because it needs to be reported for every transaction separately. Whereas the EC sales list is on a monthly or quarterly basis for all the transactions in 1 month or 1 quarter. So, for example, what you see here is that company A in France sends an e-invoice to company B in Germany. Then both the parties will need to report this transaction under the digital reporting requirement to the local tax authority. So it applies to both the issuers and the recipients of the cross-border invoices. So in this slide, we want to have a closer look at the requirements of the DRR. So when a transaction needs to be reported, but also what data must be reported for every transaction, how you can report a transaction, and how the data is used. So let's start with the timing. Under the DRR, you have 5 days after the e-invoice is issued as a supplier to report this transaction under the DRR. As a customer, you also have 5 days after the e-invoice is received to report this transaction under the DRR. Now, what must be reported is the data. In principle, it is the same data that is mentioned on the e-invoice. However, in some cases, it might be that some information is not mentioned on the invoice, but it still needs to be reported. And I think the best example here is for reverse charge transactions, because in that case, the VAT amount is not mentioned on the e-invoice, because it needs to be accounted for by the buyer. But still, in that case, the VAT amount must be reported under the DRR. And how to report this transaction? I think it's good to mention that because the ViDA package is quite new and it's just been published this year. Many member states do not have a mechanism in place yet to report the transactions to their local tax authorities. So it's not yet known how the transactions will need to be reported. But it's already clear that if a transaction is reported to the local tax authorities, then they will report this transaction to the EU transaction database or the central fees. And they will have 1 day to do so. So that means that it's almost near real-time reporting. And how is this data then used? This data is then used by the persons that are handling this database. And this data is then automatically cross-checked and aggregated for transactions between different member states. And this will also be linked with the Central Electronic Payment System, or CSOP, whereby certain payment service providers need to collect the payment data of their customers, and the data of the DRR will be compared with the data under CSOP. And this is all to prevent the VAT fraud and to reduce the VAT gap. So that concludes Pillar 1 about e-invoicing and the digital reporting requirement. I hope this was clear, and now we move on to Pillar 2 about the platform economy, and this will be discussed by my colleague Bart.
Thank you, Michel, for this introduction. Helpful to have a little bit background of the ViDA package and the discussion of the first pillar. I will do the second and the third pillar. The second one is about the platform economy. The third one is the single VAT registration, and I will discuss when they are due, what the impact will be for the businesses. Let's move on to the second pillar, the platform economy. And the first aspect of the platform economy is the proposed rule that make platforms liable for charging and remitting VAT when they facilitate a supply of passenger transport or short-term accommodation. This is also called the deemed supplier rule and will be applicable as of the 1st of July of 2028. The platform economy pillar seeks to shift the VAT liability to the platforms, and this is mainly important to increase a level playing field between the online and traditional business models. The platforms are only in scope of the provision if they facilitate the underlying supply. And this means that they should allow a customer and a supplier to enter into contact via an electronic interface. And that contact should result in a supply of services through that electronic interface. So, in other words, the sale purchase from the supplier to the customer is concluded with the help of a taxable person operating the platform. Please note that there are no that there is no facilitation when the platform is not involved in setting the terms and conditions under which the supply is made. Also not involved in authorizing the charge to the customer and not involved in the provision of the supply. So if these three are applicable, then there is no facilitation. Yeah, you may already know about this deemed supply rule, because since 1 July 2021 the deemed supply rule is already applicable for the B2C e-commerce sector for the supply of B2C goods. And it applies in two situations. The first one is the platform that facilitating a supply of goods by a non-EU supplier selling these goods from an EU warehouse. So that is the distance sales in the EU. And the other situation is that platforms facilitating the supply of goods with an intrinsic value not more than 150 euros from outside the EU to EU consumers. In these two situations, the deemed supply rule is already applicable. And under this deemed supply rule, a platform is deemed to have purchased and subsequently supplied the underlying goods and services to the customer. And this makes the platform liable for the payment of VAT on the transaction to the customer. For clarity, short-term accommodation, this category only relates to rentals for 30 nights or less. And the deemed supply rules in principle intended to apply in circumstances where the underlying supplier is not required to account for VAT on the supply. This can, for example, be the case if the supplier is an individual acting in its private capacity, or if the supplier is a small business operating under a VAT registration threshold. Those supplies are not subject to VAT, and with the deemed supply rule, they will be subject to VAT. There is, however, a situation where the platform will not be liable, and that is if the underlying supplier provides a VAT number to the platform and declares to the platform that it will account for VAT on the supply. So here the supplier keeps control of his activities and the VAT treatment of it, and this can also be helpful for suppliers that would like to make use of input VAT deduction of their purchases. There are further additional options for member state to implement as part of the changing deemed supply rule. Member state can first of all postpone the introduction to 1 January 2030 at the latest. And a second important change is that member states may choose to not make the platform a deemed supplier if the underlying supplier qualifies and opts for the small and medium-sized enterprise VAT regime. So for those platforms acting with these suppliers, the deemed supply rule is not applicable if the member state opts for it. Due to such options, member states keep having flexibility in defining the rules and conditions, but it may also create additional complexity because different rules and different timing of implementation will be applicable in different member states. That can create some some complexity to businesses that operate in different countries. Platforms that are qualifying as deemed supplier, they have an obligation to keep records of the supplies for 10 years. But new to this deemed supplier rule is that platforms that facilitate the short-term accommodation rental and passenger transport services and are not a deemed supplier, they must also keep records of the transactions via the platform. These records must be made available on request to the member states electronically and must also be kept for at least 10 years. Last point about the deemed supplier rule is that there is a safe harbor for situations where the deemed supplier rule is not applied by the platform and where it should have been applied. In case there is the platform is dependent on information provided by the supplier, and if that information is incorrect, in that case there is no liability for the platform as a deemed supplier. And the platform should be able to prove that it could not have known that the information received from the supplier was incorrect. The changes under this pillar, they mainly affect platforms in the passenger transport and accommodation sector. However, ViDA also include rules that will affect platforms facilitating other types of goods and services. And these changes will also effective from 1 July 2028. In this respect, the facilitation service provided by a platform will be regarded as an intermediary service, and the place of supply of these facilitation service to private individual, so in B2C situations, will be where the underlying service takes place. And an example for this is if a facilitation service by a platform for a short-term accommodation rental to a supplier acting as a private individual, that facilitation service will take place where the underlying service takes place, and that is where the accommodation is located. To compare this with facilitation service in a B2B situation, there are already rules in place to facilitation service to other businesses because those services qualify as general services for which the place of supply will be the member state where the recipient is located. And in those cases, the general reverse charge mechanism applies. Another rule will be that platforms facilitating supplies of goods and which hold goods owned by the supplier, these platforms will be required to inform the supplier if the goods will be moved to other EU member states. So that's happening when, for example, fulfillment centers are used in different EU member states where the supplier keeps the ownership of the goods. If these goods will be moved to other member states, then the platform should inform the supplier about this. I think in most cases this is already happening, but now it's formally required. The impact for businesses, I think it's clear that this pillar is quite sector specific. For businesses operating in the passenger transport and accommodation sector, the impact is significant. And in addition, there will also be an impact for suppliers that offer passenger transport and accommodation services on platforms. In particular, those who are currently not required to charge VAT on those supplies. When a platforms going forward will be required to apply VAT to these supplies, it will of course have an impact on the price of the services. All right, that was pillar 2. Now we move on to pillar 3, last but not least, the single VAT registration. And this pillar aims to reduce the need of multiple VAT registrations. And in this respect, we will see that the OSS scheme becomes more and more important. And where the previous pillar was mainly relevant for accommodation and passenger transport sector, this pillar is less sector specific. I believe that much more of our clients can relate to this pillar, as setting up an e-commerce business can easily result in the need of multiple VAT registration. Think about the use of fulfillment warehouses throughout the EU. So this will also be an important pillar for those businesses. The existing OSS scheme for business for B2C distance sales of goods and certain services makes it possible to pay VAT on those supplies across multiple EU countries via one single OSS return. And the EU member state where the business is registered for the scheme will forward the relevant part of the VAT return and the VAT payment to the EU member state where the VAT is due. And this existing OSS scheme will be extended to other B2C supplies. From 1 January 2027, it will be extended to supplies of electricity, gas, heating and cooling. And from 1 July 2028, the OSS will be extended with B2C supplies with installation or assembly, B2C supplies of goods on board of EU passenger transport, think about ships and trains, and also from 1 July 2028, the B2C domestic supplies of goods will be captured by the OSS scheme. There will be a new OSS module for businesses to report movements of their own goods between EU member states. Currently, the movement of own goods between member states triggers a local VAT registration obligation in both the country of dispatch and arrival of the goods, with a few exceptions on this. But it mainly triggers the need for a local VAT registration in these situations. However, from 1 July 2028, a business may choose to report the intra-EU movement of own goods in the OSS. So there is no longer a need to report the acquisition of own goods in the member state of arrival. And this intra-EU acquisition will be exempt from VAT. This special scheme for the transfer of own goods will only apply to goods for which a full right of deduction exists. So that must be that's something to be aware of. And yeah, businesses must be able to provide records that are sufficiently detailed for the tax authorities to verify the country of dispatch and arrival of the goods, and to check whether the transfer is correctly reported. EU businesses can report the movement of own goods in the member state of establishment, and for non-EU businesses this will be the member state of departure of the goods, which is similar to what's going on with registering for the OSS scheme at the moment. And there is an all or nothing principle for the transfer of own goods scheme, so or you report all your transfer of own goods in this scheme, or you cannot make use of the new scheme for transfer of own goods. If you would like to use your local VAT registrations for the transfer of your own goods. And as a result of this new scheme for the transfer of own goods, the call of stock simplification will be phased out also as of 1 July 2028. And within this call of stock simplification, businesses can keep stock abroad without having a local VAT registration, and only in the situation where your end customer is already known. And the use of this call of stock model makes it possible to avoid a local VAT registration if you bring your goods to the country of your end customer. And at the moment the end customer calls off the stock, an intra-EU supply occurs. But with this current call of stock model will become redundant as a result of the new OSS scheme for the transfer of own goods. Therefore the call of stock model will be abolished from 1 July 2028. That means that after 30 June 2028, businesses cannot make new transfer of stock supplies under the EU call of stock model. However, for the call of stock model, a 12-month time limit applies for transferring the goods to the intended customer. So, from 30 June 2029, the simplification will officially no longer be existing. And all movement of goods can then be reported via the OSS scheme. Then the domestic reverse charge mechanism for B2B transaction will also be extended. Currently, suppliers may be required to register for VAT in a member state where they are not established, because the VAT is due in the member state where the supply of goods of service takes place. And for example, if a Dutch supplier is selling goods in Germany to a German business, or provides services related to immovable property, then he is required to register in Germany for the local supply, and member states can opt to apply a domestic reverse charge mechanism on such transactions. But that's fully to the member states whether to implement such domestic reverse charge mechanism. And at the moment there are many differences in the application of the local reverse charge mechanism between different member states. Some member states don't have a local reverse charge mechanism at all, or there are different conditions for the application of such domestic reverse charge. But under the new rules, member states will be obliged to allow the reverse charge if a non-established supplier is not VAT registered in the member state where the VAT is due, and where the customer does have a VAT registration in that member state. And this new rule will reduce the situation where non-established suppliers need local VAT registration in other member states. Then there is an additional option for member states, and within this option they can require the customer to register for VAT in the member state where the VAT is due in order to apply the domestic reverse charge mechanism. In the Netherlands, at the moment, the domestic reverse charge already applies to all local supplies of goods and services by non-established businesses if the recipient is established in the Netherlands. And this means for the Netherlands that the scope of the reverse charge will be further extended to supplies to all VAT registered businesses in the Netherlands. The supply of goods under the margin scheme for second-hand goods is excluded from the reverse charge mechanism. And in terms of reporting, the supplier is required to include the supply for which the VAT is reverse charged in its European sales list from 1 July 2028. And as discussed by Michel, from 1 July 2030, both the supplier and customer needs to report this transaction under the rules for e-invoicing and digital reporting requirements. So the impact for businesses, the changes under this pillar will likely reduce the amount of VAT registrations for businesses operating throughout the EU, and with that also the associated compliance costs. It is therefore expected to be a welcoming change in the VAT system. However, from 1 July 2030, the changes will be accompanied by increasing obligations in relation to e-invoicing and digital reporting, and this may generate additional cost for business on the other hand. It's also good to mention that making intra-EU supplies in other EU countries still require a local VAT registration in the member state of dispatch of the goods. And also input VAT incurred in other member states cannot be reclaimed via the single VAT registration. The reclaim of input VAT should be managed or via a local VAT registration or via an EU VAT refund procedure, and the latter procedure can be a long one, which may have a negative impact on your cash flow. While the new rules for the single VAT registration should reduce the circumstances in which businesses have to apply for a local VAT registration, it will not completely eliminate the need for such registrations. So it is recommended that businesses need to consider whether it's preferable to maintain or apply for foreign VAT registrations, or to maximize the use of simplifications. That was the last pillar. So then we come to the last part of our webinar, and I will give the word to Michel again.
Yeah. So as we come to the last part of the webinar, the next 2 slides focus on how businesses can prepare for the changes under the ViDA package, both strategically as operationally. Even though the changes will be rolled out in phases over the next few years, we think it's important to start preparing early to avoid any last-minute surprises or disruptions. So where to begin? So first of all, we think it's really important that you understand the scope of the changes of ViDA. And as you heard today, the changes are quite technical by nature and sometimes difficult to understand. So I think it's important that you have a good understanding of how the VT system works. And you need to have a basic understanding of the VT rules. And that will make it easier to implement the upcoming changes. Next, we recommend to carry out a review of your business structure, your activities and your current VT registrations in the EU. This will help determine where and how ViDA might affect you, and the impact won't be the same for everybody. It depends on your business model and your supply chain, and so the impact might be different for everybody. And of course, one of the biggest changes is the e-invoicing and the digital reporting requirement. So of course you need to check your invoicing systems, whether they are ready to implement the e-invoicing format that is required under ViDA. And lastly, we highly recommend to prepare an impact report with a plan of action and also a timeline for the implementation. This way you can make your organization your organization can make the necessary adjustments in a timely and a structured way. So then we move on to the operational preparation. So ViDA needs to be implemented in the local legislation, so every member state in the EU has to implement these changes in the local VAT laws. And as you heard today, there are some mandatory requirements but also some optional conditions. So that means that the implementation might be different in each EU member state. So that's why it's important to stay updated on how ViDA will be implemented in the different European countries. Second, for the implementation, it's not only important that the tax team or the finance team will be busy doing that. I think it's important that you involve all the stakeholders in the organization. So that means you need to involve your IT team, your legal team, your finance team, your operational team, because one way or another they're all involved in VAT processes. And ViDA will touch upon systems, processes, compliance and reporting. So collaboration across these departments is very important. And as we said, the most significant changes will be to the invoicing and also I think to your accounting system. So you need to make sure that your invoicing system is ready to implement the structured e-invoices under ViDA. And also you need to make sure that your accounting system is up to date so that it applies the correct VAT treatment of transactions under the changed laws under ViDA. And I think it's also a good time to review all your VAT registrations across the EU. So for some VAT registrations, I think you need to decide whether you want to keep them or whether you want to deregister them, or maybe you have to deregister them. And lastly, I think after all the implementation is done, you need to test everything to make sure that everything is implemented correctly. This testing includes the technical setup, the data flows and the reporting logic. Once the testing is complete and the system is stable, then of course you can go live. So that summarizes the preparation for ViDA, and that also concludes our webinar of today. And thank you for joining us. We hope this webinar gave you a clear overview of the upcoming changes under ViDA and how to start preparing. If you have any further questions or would like to discuss how ViDA might impact your business, then feel free to reach out to us. And of course, we will have a look at the questions that are being posted in the chat, and we'll get back to you on these questions. Thanks again for your time, and we look forward to connecting with you soon. Bye-bye.
Bye.